I've been a retirement advisor now for over 20 years, and I consider myself one of the luckiest people in the world. Why? Because that 20 years happens to coincide with 20 super strong years in the stock market and a period of economic growth for the United States, a period of low inflation. But one of the foundational tenets, one of the foundational rules in my industry is what's known as the 4% rule, which is how much money people can afford to spend off of their retirement account over a 30-year period and not have to worry about running out of money. And for my entire 20 years, that 4% rule is kind of the golden rule. The question is, in a period of high inflation, does the rule still work? Do you need to be worried? That's what today's video is, so let's jump in and talk about it. So the guy that came up with the 4% rule back in the day, back in 1994, is a gentleman by the name of William Bengen. My question about inflation is a really important question, but you know, the nice thing is you don't have to take Azul's word for how higher inflation impacts his rule, the 4% rule, because we have Bengen's thoughts, and I'm going to share that with you in a little bit. But first, I need to give you a little bit of background. So again, Bengen came up in 1994 and answered a question that we really didn't have a good answer to prior to the 1994, which is, you've saved up $500,000, you've saved up $1 million, whatever the amount is, and now how much money can you spend without worrying about running out of money during your lifetime? Let's call it 30 years. So Bengen's breakthrough was using a statistical tool which at the time was not that well known. It's called a Monte Carlo simulation. Suffice it to say, it's a sophisticated tool. That was a good tool to use for the job. It essentially is trying to simulate 10,000 lifetimes, 1,000 lifetimes, and look at that and say, in these hypothetical cases using real stock market data, what percent of the time did people run out of money? Now, once you've quit working, the idea of running out of money is a really scary thing, obviously. So Bengen used 3% and said, okay, if 97% of the time people did not run out of money, that would be a good thing. That's where the 4% rule came out. So just for easy math, if you had $500,000, Bengen's rule would say you could take out $20,000, 4% of $500,000. You can take out $20,000 the first year, but importantly, in the second year, you can take out that $20,000 plus whatever inflation might have grown to. So let's say inflation was 3%. Then your second year, you can take out $20,600. Hopefully that makes sense. Okay, so as I said, Bengen has given us his thoughts on how inflation impacts his role, and in fact, he did a study. And so he revealed the results of this study in 2021, but before we go there, I need to tell you about another player in my industry, another thought leader, another father of financial advising, which is a gentleman by the name of Michael Kitces. And Kitces looked at Bengen's data and said, it's good, I like it, it's super helpful, but it could be better. And Kitces' aha revelation was, you know, how the stock market does in the future really depends in part on how expensive things are today. If the stock market's at all-time highs and it's super expensive, then one could expect the results would be lower in the future because we've kind of brought forward returns. So in this chart, you can see what Kitces did. Kitces basically took the same data that Bengen had and said, well, there were years where the stock market was really expensive, and there was years where the stock market was not expensive. For instance, right after the Great Depression, nobody wanted to own stocks. So stocks were at all-time lows, and Kitces' study said, okay, he broke the stock market into 5 quintiles, 5 sections, from the underpriced, from the least expensive to the most expensive, let's call it that. And in this chart that you're looking at here, you can see this CAPE ratio, and it's just how much people are willing to pay for a future dollar of earnings. Let's just keep it simple. Anywhere from 7.4 to 10.2 was the least expensive that the stock market got. And during that period of time, what Kitces found is people could take out anywhere from almost 7% to a little over 10% a year and not run out of money. and the average there was 8%. And then you can see when the stock market was the most expensive, for this future dollar of earnings, people were willing to pay almost 20 to 27 times. It was 18.7 to 27.1 times that future dollar of earnings. You can see that's where we got the low numbers, all the way from 3.8% on the low to 6.1% withdrawal rate, with an average of 4.5%. So now we have the foundation. Now let's fast forward to 2021, where Bill Bengen updated his famous 4% rule. Bengen's talk, he references the improvement that Kitces did, and then he said, you know, there's a missing link. Yes, valuations were important, but the other thing that was important was inflation. And in this chart, you can see Bengen's breaking down of inflation really into 4 categories. The first category is deflation. And then we have low inflation, which is 0 to 2.5%. We have moderate inflation, which is 2.5 to 5%, which is where we find ourselves now. And then we have high inflation periods, which is a period that we just left. Hopefully we don't return to that. But where inflation was greater than 5%. What did Bengen find? He found that with low inflation, you could take out about 5% to 8% a year. Just kind of, I'm finding the median in that up and down graph that for that different colored section. For moderate inflation, to my eye, it looked like that withdrawal rate was 6 to 9%. And then for high inflation, where inflation was greater than 5%, that's where you can see the withdrawal rate is 4 to 7%. So again, Bengen, initial work, Kitces talks about valuation. Bengen comes back and says, Michael, great job. Valuation does matter, and we're going to toss inflation on it. So what does all this mean to you? What it means to you is this is an important question. And the difference between a 4% withdrawal rate and a 4.8% withdrawal rate, that's like getting a 20% raise. That's, you're taking 20% a year out more, right? In that hypothetical $500,000 portfolio, 4% of that is $20,000, but 5% of that is $25,000. I don't know about you, but I'd much rather spend $25,000 a year than $20,000, and $25,000 than $20,000. So it's an important question. I wish we could just plug it in a formula and give you the answer, but that's not how it works. I suggest that you work with a fee-only financial advisor, somebody that's a fiduciary to you 100% of the time, and come up with the answer that's right for you. I will share with you, to the extent that you're adaptable, and most of the clients that I work with are adaptable, you know, if you want to be closer to that 5% withdrawal rate, I think you'll probably be okay. Just realizing you might have to throttle it back in future years. What about 6%? Could you get by with 6%? No. You should talk to a financial advisor. But again, as long as you're willing to be adaptable and change in the future, I think there's a lot of things you can try out. So hopefully this video has been helpful. I want you to think about watching this video here, because I think how much you can spend in retirement is important. But I also think it's important to enjoy the journey up until retirement. And that's what this video talks about. 7 things that I'd like you to stop doing in your 50s and 60s in order to enjoy your journey up until the time you get to retire. Thanks for watching this video. I'll see you in there. Bye-bye.